3 years ago, the United States government flipped a switch and 300 billion vanished. Not stolen, not bombed, just turned off. And the decision that followed in finance ministries from Riyadh to Beijing to Warsaw is quietly reshaping every portfolio on the planet, whether you know it or not. If you've ever wondered why gold keeps climbing while analysts keep calling the top, stay with me. Because what's actually driving this move has nothing to do with inflation fears or recession headlines. It goes much deeper than that. And by the end of this video, you'll understand why the investors who get this right now will look like geniuses in 5 years. If this kind of analysis is useful to you, hit the like button right now. It tells me to keep making content like this. Here's what actually happened on February 28, 2022. Russia's central bank woke up to discover that $300 billion in foreign currency reserves, money Russia had carefully built up over 20 years, was completely inaccessible, not seized in court, not frozen after a legal process. A digital instruction sent through the correspondent banking network that runs the global dollar system simply shut the door. The single largest immobilization of sovereign reserves in peacetime history, done in hours. And every finance minister on earth was watching. Riyadh, Warsaw, New Delhi, Beijing, Brasilia. Within days, the same question was circulating in every central bank that held significant dollar reserves. If it can happen to Russia, a country with nuclear weapons, a UN Security Council seat, and the world's largest natural resource base, what does that mean for us? That question changed everything. And the answer is now visible in the data, if you know where to look. Drop a comment below. Did you know central banks were buying gold at this scale? Most people have no idea. Before February 2022, the world's central banks were collectively buying roughly 17 tons of gold per month. That was already an elevated pace compared to historical norms. Since February 2022, that number has jumped to approximately 60 tons per month, 3.5 times higher, sustained without interruption for over 3 years. And the World Gold Council's most recent survey found that 95% of central bank respondents plan to maintain or increase their gold purchases in 2026. 0% plan to reduce. This is not a trend. This is a structural reallocation, and it's being driven by 4 buyers, each one revealing a different layer of the same tectonic shift. Start with China. The People's Bank of China officially reports gold holdings at around 10% of total reserves, modest by international standards. But here's what the official number doesn't show. Approximately 57% of all central bank gold purchases globally last year were reported as purchases by institutions that don't publicly disclose their identity. When analysts cross-reference those flows against Swiss refinery shipments, trade data, and vault movements, one buyer overwhelmingly matches the pattern. China runs a massive trade surplus with the United States. For decades, those surplus dollars recycled into U.S. Treasury bonds, financing American debt at artificially low rates. A portion of that flow is now being quietly, systematically redirected, not into bonds, into physical gold, transferred to vaults inside China's own borders. Gold that, unlike treasury bonds, cannot be turned off by a banking instruction from Washington. Then there's Poland, NATO ally, EU member, no adversarial history with the United States, no reason, by conventional logic, to fear dollar weaponization. And yet Poland's central bank governor stood in front of the press in January and cited national security as the reason for gold purchases. Finance officials in peacetime do not use the phrase national security without deliberate intention. Poland sits on Europe's eastern border. It watched from the front row what frozen reserves look like as a geopolitical weapon. Its conclusion, physical gold, held in its own vaults, provides a form of security that no amount of alliance strength can replicate in the dollar system. Saudi Arabia is the most consequential piece of this puzzle, and also the most hidden. In 1974, Henry Kissinger struck an informal deal with the Saudi royal family. Saudi Arabia would price its oil in US dollars, ensuring that every nation needing oil first needed dollars. In return, the U.S. provided military protection. That arrangement, the petrodollar, is the mechanical foundation of the dollar's reserve currency status. It created structural, permanent global demand for dollars that had nothing to do with America's financial attractiveness. Saudi Arabia publicly states it is not buying gold. Swiss refinery and trade data suggest otherwise. Industry analysts tracking flows from Swiss refineries, which process the majority of the world's gold into standard delivery bars, have identified approximately 160 tons imported by Saudi Arabia over recent years, in quantities and formats consistent with central bank accumulation, not retail demand. The architects of the petrodollar appear to be quietly converting a portion of their dollar revenues into the one asset the petrodollar was designed to replace. And then there's everyone else. 22 central banks reported gold purchases last year. Kazakhstan, Brazil, India, Ghana, Indonesia, the Czech Republic, Uzbekistan. Countries with no common geopolitical interest, no coordinated policy, no shared institutional framework. All independently arriving at the same conclusion about what it means to hold dollar-denominated reserves in the post-2022 world. This is what a structural shift looks like, not a conspiracy, not a coordinated attack, a rational, decentralized, institution-by-institution reassessment by the people with the most complete information about the risks inside the current system. If this is making you think differently about your own portfolio, share this video. Most investors are completely blind to what's happening here. Now let's talk about what this actually means for price. Not sentiment, not narrative, but supply and demand arithmetic. All the gold ever mined in human history is worth approximately $29 trillion at current prices. The planet produces roughly 3,500 tons of new gold per year. At current prices, that's around $280 billion in new annual supply, less than 1% of the total stock above ground. Central banks at their current pace are absorbing approximately 720 tons per year. That is more than 20% of all new annual gold production consumed by sovereign buyers alone before a single private investor, jewelry buyer, or industrial application adds their demand on top. Here's the part most analysts are missing entirely. When oil prices rise, new drilling starts within months. When copper rises, previously uneconomic mines come back online. Almost every commodity has a relatively fast supply response that eventually restores equilibrium. Gold does not work this way. A new gold mine requires permitting, exploration, construction, and operational ramp-up spanning 10 to 15 years. The price can double tomorrow, and the supply response won't be visible for a decade. The planet is producing roughly the same amount of gold it was producing before the central bank buying surge tripled. The supply is fixed, the demand has tripled, and the force driving that demand is not cyclical. It doesn't diminish when prices rise. It is structural, driven by a permanent revision of how sovereign institutions view the risk of holding dollar-denominated reserves. Now here's the reframe that I think most investors need. Because the most common question I see is, has gold already moved too much? Should I wait for a pullback? That is the wrong question entirely. Gold moved from roughly $1,800 in February 2022 to approximately $3,300 today, a move of over 80% in 3 years. During the correction from the January 2026 peak of around $3,500 back toward $2,900, every comment section filled with the same reaction. Bubble popped, thesis broken, time to sell. But look at what actually changed during that correction. Central banks did not stop buying. China did not start selling. Poland did not abandon its national security framework. Saudi Arabia did not reverse its Swiss refinery flows. The U.S. deficit did not reverse. The thesis did not change. The paper market moved. The structural forces did not. The historical parallel worth understanding is not 2008 or 2011. It's 1974 to 1976, the middle of the greatest gold bull market of the 20th century. From 1971 to 1980, gold moved from $35 to $850, a 2,400% move. In the middle of that run, from late 1974 to mid-1976, gold fell 50%. 50% during the largest gold bull market in modern history. The investors who sold during that correction missed the move from $110 to $850 that followed. The structural forces, the collapse of the gold standard, the fiscal excess, the inflationary aftermath, had not changed. The paper market had. The investors who understood the difference held through the volatility and captured the full structural move. The structural forces today are arguably more powerful than those of the 1970s. In 1974, U.S. national debt stood at roughly $500 billion. Today it stands at $36 trillion, growing by approximately $1 trillion every 100 days. In 1974, central banks were net sellers of gold. Today they're buying 60 tons per month and surveying at 95% intent to continue. In 1974, there was no documented precedent of the reserve currency being weaponized to freeze a sovereign nation's financial assets. Today, that precedent is a documented permanent feature of the geopolitical landscape, incorporated into the risk framework of every sovereign treasury on Earth. Let me be direct about the three most expensive mistakes I see investors making right now. The first, confusing a paper market correction with a change in the investment thesis. Price moved. The structural buyers did not stop. Those are two completely different things, and conflating them costs real money. The second, treating a gold ETF as equivalent to physical gold. A gold ETF is a financial claim, a paper instrument that promises to track the price of gold, backed by counterparty obligations inside the same U.S. regulated financial system that frozen Russia's reserves. Central banks don't buy ETFs. They buy London good delivery bars and store them in their own vaults. The reason is exactly the lesson of February 28, 2022. A paper claim is only as reliable as the counterparty backing it. Physical gold, held in your possession or in a fully allocated, audited, segregated account, has no counterparty. It is the only reserve asset in existence that cannot be frozen, sanctioned, or switched off by a digital instruction from a foreign government. ETFs have legitimate uses for price exposure and tactical positioning. But investors whose thesis is structural, who are buying gold as insurance against monetary debasement, fiscal excess, and reserve system instability, should understand that the central banks are expressing that thesis through physical metal, not paper claims. The third mistake, going all in. Gold does not generate cash flow. It does not compound. It does not pay dividends. It is an insurance policy, a store of value that preserves purchasing power across monetary transitions. Insurance policies are not meant to be your entire portfolio. The institutional consensus across sovereign wealth funds, family offices, and long-duration investors converges around a 5 to 15% allocation to gold as a structural portfolio component. Within that range, the appropriate allocation depends on your existing exposure to dollar-denominated assets, your time horizon, and your capacity to hold through volatility. Because every structural multi-year move generates significant volatility along the way. What I am not saying is that today is the perfect entry point or that gold moves in a straight line. The paper market will generate corrections. The dollar will strengthen during acute crisis episodes. Fed rate expectations will create headwinds at certain moments. These are predictable, normal characteristics of how the paper market behaves. They are not evidence that the thesis is broken. They are evidence that the paper market is doing what it always does, reacting to short-term capital flows and sentiment rather than to the structural forces that determine long-term value. The structural force here is the most significant sovereign reallocation of reserve assets since the Bretton Woods Conference of 1944. It was triggered by a single event on February 28, 2022, and reinforced by every subsequent month of geopolitical tension, fiscal deterioration, and currency weaponization that has followed. The $29 trillion above-ground gold market is not large. At 60 tons per month of sovereign absorption, the structural buyers alone are consuming the equivalent of more than 20% of all new annual supply, before any private, industrial, or investment demand is added. The supply response is constrained by a decade-long capital cycle that cannot be accelerated regardless of how high the price goes in the near term. The repricing that reflects the full structural shift has not yet occurred. At $800 in February 2022, gold was pricing a world where dollar reserves were the unquestioned safe haven of sovereign wealth. The price today is beginning to price a world where that assumption has been fundamentally and permanently revised. The full repricing of a world where 60 tons per month of sovereign demand is permanently redirected from dollar assets into physical gold has not yet been reflected in the market. The central bank started running in February 2022. Most retail investors are still standing at the starting line, watching the runners disappear into the distance, asking whether it's too late to begin. Every prior structural monetary transition in the historical record suggests that it is not too late. These transitions are slow until they are suddenly fast. The repricing is gradual until it is abrupt. And the investors positioned before the sudden phase are the ones whose portfolios look in retrospect like they made an obvious decision at an obvious moment. In the present, those decisions never feel obvious. They feel uncomfortable, uncertain, and premature. That discomfort is the exact cost of being positioned ahead of the consensus. The data is public. The capital flows are measurable. The structural forces are documented. If you're thinking seriously about what this means for your portfolio, share this with someone who needs to hear it. And if you want analysis like this on a daily basis, subscribe. No hype, no noise. Just the structural forces that actually move money.